Gold just hit $5,600 per ounce, the highest price in all of human history. At the same time, Bitcoin hit $126,000, also an all-time high. Two assets, both breaking records, both screaming at you to pay attention. But here is the terrifying part nobody is telling you. One of them is about to leave the other in the dust. And if you are on the wrong side of this trade, your savings could take a hit you won't recover from for years. I have the real data. The Wall Street analysis. The JPMorgan reports. And in the next 4 minutes, I am going to tell you exactly what smart money is doing right now. Before we dive in, if you are watching this channel for the first time, hit subscribe right now. Here is why this channel is different. I don't do clickbait. I don't do hype. Every single number I give you, I source from JPMorgan, BlackRock, Goldman Sachs, and Fortune. Real institutional data for everyday investors. This is the channel where Wall Street's research meets Main Street's wallet. Subscribe. Bell icon. Let us go. Let us start with gold because gold's story in 2026 is absolutely stunning. On January 28, 2026, gold hits $5,595 per ounce. All-time high. 1 year earlier, it was sitting at $2,700. That is a 70% gain in 12 months. Why is gold exploding? 3 reasons, and all 3 are still active right now. Number 1, inflation is back. The latest CPI report shows inflation climbing to 3.3%. The highest since May 2024. Monthly prices surged 0.9%. The steepest monthly rise since mid-2022. When your dollar buys less, gold becomes more valuable. Simple. Number 2, central banks are hoarding gold like never before. JPMorgan reports central banks are expected to buy 755 tons of gold in 2026. Compare that to pre-2022 averages of 400 to 500 tons. When governments don't trust each other's currencies, they buy gold. And they are buying aggressively. Number 3, geopolitical fear. United States and Iran tensions. Oil above $100 per barrel since March. Trade wars. Dollar weakness. Every single one of these is a tailwind for gold. JPMorgan's official forecast is $5,000 per ounce by year-end 2026. Goldman Sachs is even more aggressive. They see $5,400 by end of 2027. Now, Bitcoin. And this is where it gets really interesting. Bitcoin hit $126,000 in October 2025. Its all-time high. As of right now in May 2026, it is trading around $80,000. Down about 37% from its peak. On the surface, gold is winning. And the numbers agree. Gold is up 65% year over year. Bitcoin is down roughly 5% for 2026. But here is what the headlines are not telling you. BlackRock, the world's largest asset manager. Their Bitcoin ETF, iShares Bitcoin Trust, pulled in $8.4 billion in just the first quarter of 2026. Total assets under management is $54 billion. Here is the shocking comparison. Bitcoin ETFs took just 2 years to accumulate what took gold ETFs 5 years after their launch. And JPMorgan just published a report saying Bitcoin is taking gold's place as the debasement hedge of choice. Why? Because when Trump announced tariffs in April 2025, gold rose 4% in the first 10 days. Bitcoin barely moved. But over the next 60 days, Bitcoin surged 23%. Gold only rose 6%. The smart money is watching this pattern very carefully. So let us put them side by side honestly. Gold. Market cap, $30 trillion. Most stable store of value on Earth. 2026 return year over year, plus 65%. Volatility, low. Predictable. Reliable. Risk level, low to medium. Best for protecting what you already have. Bitcoin. Market cap, $1.5 trillion. 20 times smaller than gold. 2026 return year to date, down roughly 5%, but up significantly from February lows. Volatility, high. It can swing 20% in a week. Risk level, medium to high. Best for growth potential and long-term upside. Here is the key insight from the data. Gold's size makes it safe but limits how much it can grow. Bitcoin's smaller size means more risk, but also much bigger potential upside. If Bitcoin ever captures even a fraction of gold's $30 trillion market cap, the math becomes extraordinary for early holders. So how do you actually make money here? Here is what the data suggests. Option 1, the conservative play. Gold. Buy a gold ETF, ticker GLD or IAU on any brokerage. JPMorgan projects gold averaging $5,055 per ounce in the fourth quarter of 2026. From today's price of around $4,500, that is still roughly 10 to 12% upside this year. Low risk. Steady. Good inflation protection. Option 2, the growth play. Bitcoin. Buy Bitcoin directly or through IBIT, BlackRock's Bitcoin ETF. You can do this in your regular brokerage account, no crypto wallet needed. Goldman Sachs, Standard Chartered, and Bernstein all project Bitcoin reaching $150,000 to $200,000 if institutional adoption continues. Higher risk, but the upside is generational. Option 3, the smart money strategy. Split it. This is what sophisticated investors are actually doing in 2026. 70% gold. 30% Bitcoin. You get the safety of gold protecting your downside, and the growth potential of Bitcoin if the institutional wave continues. The data is clear. Both assets are responding to the same macro forces: inflation, dollar weakness, and global uncertainty. The question is just how much risk you can stomach. Bottom line. In 2026, you cannot afford to ignore either of these assets. The world's biggest banks, JPMorgan, Goldman Sachs, BlackRock, they are all positioning in both. The real question is, are you? If this video gave you value, smash that like button. It helps real investors like you find this content over the noise. Subscribe for weekly deep dives just like this one. And comment below, Team Gold or Team Bitcoin. I read every single comment. I will see you in the next one.